In 1995, buying a single share of stock cost you $30 in commissions. Today, it's free. You can do it from your phone while standing in line for coffee. The barrier to entry has never been lower, the tools have never been sharper, and somehow, the average investor has never been more likely to lose money. Something broke when the gates opened, and no one wants to talk about what walked through.
This is the quiet paradox of modern investing. We solved the access problem so completely that we created a new one. The question isn't whether you can invest anymore, it's whether you should. When the casino looks exactly like a college savings app, when influencers sell courses on beating the market between ad reads, and when your coworkers' meme stock windfall makes you feel like you're already behind. The mechanics of buying stock have become frictionless. The mechanics of understanding stock have become infinitely more complex. And that gap between ease and clarity is where fortunes quietly vanish.
Let's rewind. For most of the 20th century, buying stock was a formal affair. You called a broker, you paid a hefty commission, sometimes a percentage of the trade. You waited. The friction wasn't just financial, it was psychological. Every transaction carried weight. You thought twice, you researched, you hesitated. And hesitation, in small doses, was protective. Then came the 1990s. Online brokers like E-Trade and Schwab slashed commissions. By the 2010s, apps like Robinhood eliminated them entirely. Trades became instant. Screens became colorful. Confetti fell when you bought your first share. The language shifted from investing to trading, from portfolio construction to plays. Access exploded. In 2020 alone, over 10 million new brokerage accounts were opened in the US. The pandemic turned millions of people into first-time investors. Stimulus checks became stock portfolios. Unemployment became day trading. And for a brief, dizzying moment, it seemed like everyone was winning.
But here's what changed beneath the surface.
When investing was expensive and slow, it filtered out noise. You didn't buy a stock because someone on Reddit said it might squeeze. You didn't sell because a chart looked scary. The cost of action was a natural governor on impulsive behavior. Remove that cost, and you remove the governor. Suddenly, the average investor is making 30 trades a month instead of 3. They're chasing momentum, reacting to headlines, buying peaks and selling troughs. The irony is vicious. The easier it became to invest, the easier it became to behave in ways that destroy returns. Studies from 2023 and 2024 confirm what brokers quietly knew all along. Retail investors who trade frequently underperform the market by an average of 6 to 8 percentage points annually. Not because they're unintelligent, but because the system is now designed to encourage the exact behaviors that lose money.
And then there's the information problem.
You'd think infinite access to data would make better investors. It hasn't. It's made confused investors. In 1985, if you wanted research on a company, you read the annual report and maybe a Wall Street Journal column. Today, you're drowning in contradictory signals. Financial Twitter says buy, TikTok says sell, CNBC says hold. Your portfolio app sends you a push notification about unusual options activity. A subreddit declares the stock undervalued. An influencer with 400,000 followers posts a chart with 3 arrows and the caption, "This is it." You're not investing anymore. You're parsing. You're filtering. You're trying to separate signal from noise in an environment specifically engineered to produce noise. Because noise, volatility, confusion, emotional swings is what generates trading volume. And trading volume is what makes platforms money.
Let's talk about what actually makes money in this system. Because it's not you. It's not even the companies you invest in most of the time.
It's the infrastructure, the apps, the market makers, the high-frequency trading firms that execute your order in microseconds and pocket the spread. When you buy a stock on a zero-commission platform, you're not the customer. You're the product. Your order flow, the data about what you're buying and when, is sold to firms that trade against you, legally, profitably. They see your order before it hits the market. They adjust, they profit. You get your shares, but you paid for them in ways you didn't notice. This is called payment for order flow, and it's how free trading makes money. Robinhood earned over $2 billion from it in the last few years. You saved $10 in commissions. They made fractions of a cent on millions of trades. You thought you were empowered. You were monetized. And the platforms? They gamified the experience on purpose. The colors, the animations, the instant feedback. It's the same design language used in slot machines and social media. Not to inform you, to activate you.
Now layer in the content economy. Finance YouTube, FinTwit, stock gurus selling courses, Discord groups with premium signals. Everyone has a strategy. Everyone has an edge. And they all want $47 a month. The difference between 2026 isn't just access to markets. It's access to people pretending to beat markets. The performance is rarely verified. The track record is often fabricated. The disclaimers are buried, but the thumbnails are sharp, the confidence is high, and the testimonials are glowing. The tragic part? Most of these influencers aren't scamming you on purpose. They genuinely believe they've cracked something. They had a good year, maybe two. They assume it's skill. They sell the dream. Then the market shifts. Their system stops working, and they quietly pivot to selling a new strategy. The cycle repeats, and the beginner, the person who just got access, who just opened an account, has no way to distinguish between someone who understands compounding and someone who got lucky during a bull run.
So what does smarter look like in 2026? It's not about finding the secret strategy or the hidden edge. It's about recognizing that ease of access was never the bottleneck. Knowledge was. Discipline was. Emotional regulation was. The best investors today aren't the ones making the most trades. They're the ones making the fewest. They're not reacting to every headline. They're building positions in companies they understand and holding them through noise. They're not chasing performance. They're avoiding mistakes. Boring? Absolutely. Effective? The data is unambiguous. Low-cost index funds, dollar-cost averaging, long holding periods. These strategies have outperformed the vast majority of active traders over every meaningful time horizon. Not because they're exciting, because they remove the human tendency to self-sabotage. The platforms won't tell you this. The influencers won't either. There's no monetization model in do less, but the math doesn't care about engagement. It cares about compounding. And compounding rewards patience, not activity.
Stock investing didn't get harder because the tools got worse. It got harder because the tools got so good they disguised the real work. Clicking a button isn't investing. It's the easiest part. The hard part is knowing when not to click, when to ignore the noise, when to let time do what effort can't. The gates are open. The question is whether you walk through them or whether you let yourself get swept in by the crowd already running in circles inside. The market doesn't care how easy it was to get here. It only cares what you do next. If this video is helpful, subscribe, like, comment, and share so that other people can see it.